Let's talk to Mike Ingram. He is a chief market strategist for WH Ireland. Very good morning to you, Mike.
Morning, Moose.
Right, I'm going to put you on a soapbox. I'm recovering from a stinking cold. This is quite exciting, isn't it?
Yeah, Chinese curse. May you live in interesting times. Well, things are getting very interesting, are they not? Yeah, I mean, look, a lot going on. I think the last time we spoke, which is quite a while ago, I said, look, the market's far too complacent on where the Fed's going. That wasn't really at all being reflected in US bond markets. And of course, really since the start of September, there's been a very major reappraisal on both those fronts. And, you know, yes, we had that Fed passing through that third rate hike of the year in September. Market took some comfort from the fact that the Fed removed the language of describing the policy stance as accommodating, and then Jerome Powell just waded back in there, going, "Well, if you think we're anywhere close to neutral at the moment, you're absolutely wrong." So set the cat among the pigeons again, and that's feeding through into a bit more equity volatility, as a closer to home, a bit more bond volatility. I think what's quite interesting is even during September, whilst you were getting this recalibration of where you think the Fed's going to go, bond market implied volatility, that MOVE index, which I think I mentioned to you right at the start of the year, actually, which was a prelude to a major shake-up in equity markets, that has started to take off as well. And then, of course, within the last 24 hours, you had the IMF wading in as well, downgrading growth. I mean, a lot of this, not a great surprise. I mean, these tend to be lagging indicators. So they've trimmed their forecasts for the EU, but the ECB have already done that. Most private sector economists have already done that. So not a great surprise there. Emerging markets trimmed there. Well, we know emerging markets had a torrid time recently, particularly in light of, a stronger dollar, higher US rates prospectively, as well as actual. But it's really the outlook for 2019 where I think a lot of people are now focusing on. We're in October 2018, aren't we? So, and they're saying, well, you know what? If we go full on trade war, and as I said before, I think this is very much tied up in the US political cycle. Midterms in the US in November. So Trump's got no incentive whatsoever to ease up on the gas on this one. So it could cut, I think they were talking about up to 0.9% from US growth and 1.6% of Chinese growth. And China has actually started to respond to this. Obviously, over the weekend, they cut reserve rate requirements. They having stabilized the currency in August, they're starting to let that slip again. You've had the Secretary of State, Mike Pompeo, have a very frosty set of talks with the Chinese, and they may well name them as a currency manipulator at some point next week. So, I would say quite a lot going on. Pays to keep your eye out. I think the momentum game, which so many have played, and it's still been profitable. Momentum strategies have paid off this year still. I think that's breaking down, and actually, again, bring it back to the Fed, bring it back to the bond markets, and also ultimately equity markets. People are wondering where this 10 years is going to go, because we're up to 3.25 now.
Yep. This is the highest in 7 years, right?
Yeah, exactly. 2011 was the last time we saw it there. Now, this has not been driven, and I've said this before, it's still true. This has not really been driven by higher inflation. Everybody goes, oh, well, bonds selling off must be inflation. Not necessarily. So if you look at what the market's baking in to nominal yields to the US 10-year, about 25% of the move that we've seen this year has been due to somewhat higher inflation expectations. Yep. But those expectations are themselves more or less where they were at the start of 2017. So they're not taking off at the moment.
Okay.
75% of that move has been down to higher real rates, i.e., a structurally more aggressive Fed. Now, the question remains, well, if we actually do start to see inflation come through, that's on top of what we're already getting. Right. And if the Fed doesn't change its tune, doesn't show any signs of doing that, then you could really start to see these 10-year yields pushing meaningfully higher. And the question is, and this has come out in recent asset manager surveys, is a lot of asset managers are thinking, if we get it to 3.5, 3.6, then you're starting to talk about a very, very major shift in the way that portfolios are structured. A shift, from equity towards fixed income, from growth, which is where the game's been for the last 15 years, to value. Major shake-ups, because you've got some very, very crowded trades in there, very concentrated position in portfolios, and it does feel a bit Russian roulette-ish at the moment. So fourth quarter, one thing we can be, I think, fairly confident of, it's more volatility. So I wouldn't be short vol at this point.
Okay, final question. I'm a UK investor. I've got a portfolio. What do I do in the shares at the moment? Okay, in terms of Brexit, interest rate cycle, 10-year money, the yield ticking up. Okay, the yield curve talks of recession and so on.
Yeah, it's a tough one. I mean, particularly in the UK, where you'd say I'm a bit worried about equity, I'm a bit worried about risk assets, which is what I kind of inferred or implied what I just said. And you go, well, hang on, should I go into gilts? And you go, well, do you know what? Gilts horrible value. I mean, if you got talking about 10-year UK gilt 1.6 and change, you're not even being compensated for inflation there. Yep. So unless you had complete and utter, if you had a 2008 scenario and you had this massive flight to safety, then maybe you're not looking too bad. The problem is that's not really a great place to hide. The way we've approached it for quite some time now, and it's actually started to pay off. It was about a flat trade last year, but it's really started to pay off in recent months. It's again to focus on the non-UK exposure within the UK. So it's miners, oils. Obviously, oils in particular has paid off really, really well. I don't think sterling at 130, for instance, is particularly good value, and obviously we know it could go a lot lower. And in terms of where the whole Brexit thing is, well, is it a coin flip? Is it not? One thing we do know is that the positioning in and around sterling, which is at the epicenter of all this, the sort of implied volatility that we've got around sterling is the highest it's been since December of last year. So, and that's steadily ratcheted up. So people are very, very uncertain. Okay, it's a personal opinion. I don't think Theresa May can get checkers through, but at the moment it seems to be the only plan on the table. But we tend to have sterling jump, and obviously that feeds through to the FTSE, and sometimes it causes a negative effect on the FTSE through stronger sterling. But it tends to be positively interpreted. So when Juncker or whoever says, "Oh yeah, we can do a deal in 3 weeks or 6 weeks or whatever," well, yeah, I'm sure a deal could have been done a year ago. The question is, what kind of deal is it going to be? I'm sure if we agree with everything the EU27 wanted, we'd have a deal tomorrow. But that isn't necessarily a good thing for the the UK, the economy, and the market. So, again, we are very cautious in the UK. We're very cautious consumer. We're trying to go for those, shall we say, currency hedges in all of that. But it's I would say in terms of asset allocation, where you are within the UK because of the lack of value within gilt is a major problem.
Mike, on that note, we run out of time. Thank you very much indeed.